Stocks attempting an intraday comeback as the S&P and Nasdaq try to rebound from their worst day since 2022. Investors bracing for more mega cap earnings and a key Fed decision in the week ahead. Joining me now is Joseph Quinlan, head and CIO of market strategy for Merrill and Bank of America Private Bank. Joe, it's great to talk to you. I wonder just from a top-down level how you're viewing the recent market action, whether it's telling us anything we should be more concerned about the fundamental outlook or not.
Not really, Mike. I mean, you know, the market was overdone with the Mag 7 companies. Economy's still in good shape. Earnings are coming in better than expected. So this pullback in technology is very healthy. Better breadth. So I think we're set up for, good fall into the rest of the year. So to me, the pullback, violent as it has been, is healthy overall for the markets.
And what would you do with it, I suppose, strategically, tactically? What opportunities have surfaced in a lot of this shuffling around?
Well, the biggest thing, Mike, we got to get a lot of people out of cash. We got a lot of people sitting in cash. We want to put them in equities, the fixed income. We're looking at energy, defense. So really, get people to come out of the money markets, look at the equities, look at fixed income. And so that's kind of the big push here, what we're doing here at Merrill.
That's interesting. So, you're obviously dealing with a very wealthy clientele there. You're part of the business, and you feel as if they're still just frozen mostly in short-term cash at this point?
They're comfortable. And why not with 5% plus, with all the volatility, the election, the move with the Fed. But we're starting to see folks come back into equities, and they want them to move into more cyclical side of the area. So with energy, the industrial, so it's happening. But boy, when you look at how much money is sitting on the sidelines, that's a lot of fodder for more upside for equities as we go into 2025. Think of that as well.
It seems like, I like the kind of rubric you have for the themes in terms of hard power, hard assets, hard hats, meaning infrastructure. I wonder as you offer that as a view, if people say, oh, but don't we already know those trends are underway and hasn't it already been exploited? What's your answer to that?
Well, Mike, take military spending, right? Hard power. Right now, global military spending is around $2.5 trillion. It's around 2.3% of global GDP. It's at an all-time low. So we're underinvested in the military, given all the tension points that we have. Hard assets, commodities, when you talk about restocking munitions, when you talk about building out the infrastructure, AI data centers, that requires minerals. And then the hard hats, the infrastructure, it's the grid, it's AI, it's bridges. So this is a long-term play, and it should be part of anyone's core portfolios, these leaders within these different asset classes.
You seem generally unworried about the immediate future in terms of the U.S. economy continuing to expand, although there have been some wobbles or at least some perceived softening in various areas. How important is it for whether the Fed to ease or for that story to change a little bit?
I mean, we're watching that very carefully. I mean, in the second half of last year, the economy grew by 4%. In the first half of this year, it grew by 2%. So it's slowing down, but the consumer data is still hanging in there. We've got an unemployment rate of 4.1%. We're in a very strong capex cycle. We're seeing global growth pick up as well, so better exports, foreign affiliate income. So we're watching the economy very carefully, Mike, no doubt about it. But when the consumer is 70% of GDP, roughly speaking, they have a job, they have income, and they spend it. It's a very simple formula, so to speak. So as long as the consumer has the income, has the job security, this economy is going to continue to plod along. And remember, Mike, this is a $28 trillion economy, so 2.8% real growth doesn't sound like much, but it's on a massive base, which means more earnings upside as we go deeper into this year and next year.